Hello. Well, we come into the new week with a number of different thematics which traders are going to be looking at. Certainly this is the start of the US earnings season and comes at a very critical time. Alcoa report tonight, and certainly earnings estimates have been coming down across the board, notably of course in the energy sector where the price of oil and price of WTI and price of Brent have obviously been in freefall. Just on that subject of energy, I think it was quite bullish, I suppose, to see Baker Hughes' statistics on Friday night coming out talking about the levels of oil rigs in the US. They fell 61. That suggests to me that US shale producers are actually cutting back on oil production. It suggests that OPEC are probably getting a bit of an upper hand now in this price war, in this market share war, which of course they've been very happy to see prices fall. So we may start seeing WTI, we may see Brent prices start to base a little bit. Of course that will have big implications on inflation expectations coming through, which of course is driving bond markets and driving currencies as a result of that as well. And of course this week we will be continuing to look at the bond market. If you look at record lows in Japan, record lows in Germany, France, Italy, Spain, for example. Is quantitative easing in Europe priced in? Well, we're going to see some big implications this week when the European Court of Justice come out with their decisions and some initial thoughts on the Germans' view that it was unconstitutional to go with the OMT, or the outright monetary transaction policy. That will have big implications on the perception around quantitative easing in Europe. And certainly from Friday we did see a big sell-off in European markets, equity markets, on the premise that they're only going to see 500 billion of quantitative easing. What's actually worked over the years in terms of certainly in the US and now so much in Japan is when we do see a quantitative easing program, the market really likes it when they see and get the perception of open-ended quantitative easing, i.e. the central bank will buy bonds in unlimited size till they achieve their objective. That's not going to happen in Europe, and they're talking about actually quantitative amounts of 500 billion. Will that create inflation? Well, if you look at inflation expectations using the swap markets, we're very, very sceptical that they're actually going to achieve that, which of course is quite bearish for equity markets, that central banks can't achieve their objective. We're also looking at volatility. The VIX last week has moved up to around that 18-19% mark. I think that's going to be a bit of a new normal over the coming weeks as well, especially with people looking at what's happening in Greece when January the 25th, when we have their election. My personal view is that Syriza will win this, and they'll win this with the extra 50 seats that they get for winning the election. They probably won't be able to form a coalition. This will then pass the New Democracy Party, who again probably won't be able to form a coalition, and then we'll have new elections further down the line. This is a thematic that's playing through. Spain over the weekend coming out of a new poll saying that Podemos have actually taken the lead in terms of the perception of the general election that takes place in November. Again, these guys are similar sort of model in terms of what they're looking for as Syriza, and they're looking for some sort of debt forgiveness and trying to grow through growth rather than austerity going forward. So I think that's interesting as well. So of course we're keeping our eye on the euro. Locally here in Australia we are expecting a slightly weaker open. I think we're looking for about 40 points to the downside. Banks are at a very critical level. If you look at where the banking index, the financial index at the moment, it's very much in thematic of levels where we saw a very aggressive selling coming through in September, November and also in December, big pullbacks there as well. So we're going to need to clear through supply over the coming days in the banking sector for the overall benchmark, the ASX 200, to continue moving higher over the short term. Locally today we do have home loan data. The market's looking for 1.7% growth coming through there. We really need for the bulls to clear this 82.16 level to create a higher high, and then perhaps push through to the 38.2% retracement level of the recent sell-off around that 83.24. I think that's a good level to look to start putting in longer term shorts into the Australian dollar there as well. And China as well this week will be very interesting because they've got their aggregate finance numbers, their new yuan loan numbers as well, and the equity market, the CSI 300, is looking very bullish at the moment, although Friday's candle was fairly bearish indeed, and we're looking for follow-through selling coming through there. Apart from that, very much focused on what happens in the US bond market as well. A big move lower in the front end of the curve last week, reflecting those rate pricing expectations. We saw Friday that's fairly benign read on wage inflation, which has really got the centre of everyone's attention at the moment. We've got a number of Fed speakers coming through this week, expecting them to be fairly dovish like we saw on Friday from the likes of Jeffrey Lacker, Charles Evans for example, and that should keep the dollar fairly subdued this week and bond yields from moving aggressively higher over the week as well. So looking for a bit of volatility to continue coming through in equity markets. Bond markets should continue to stay low. We're looking for euro dollar as a sell on rallies, and Australian dollar as well to be a sell on rallies as well.